Let's stick with oil now on the company level. Exxon raising its annual share buyback after posting its highest profit on record. Bloomberg's Kevin Crowley joins us now with more details. Kevin, we got a lot of readout stuff from Exxon over the last 12 hours. What were some of the highlights that stood out to you?
Well, they increased their share buyback for the second time this year to $50 billion through the end of 2024. So they're quite incredibly confident of the financial returns in the future. They also stuck their capital budget to their medium-term range of between $20 and $25 billion or so, which shows that they are not going to chase production. They did not respond to the super high oil prices that we saw earlier this year. They're sticking within that fairly restrained capital budget, but it is up significantly on 2021 and 2022 as well. I mean, the big takeaway for me, both with Exxon and Chevron, is that they're still very, very confident on the Permian. They're investing a lot of capital into U.S. shale, as opposed to the big mega projects that we've seen in previous upcycles. Certainly over the past decade or so, those mega projects are still seen to be quite high risk, especially when we have energy transition, and these projects typically take decades to pay off.
So, Kevin, just on that point for a second, there's been a lot of concern about asset maturation or resource maturation, particularly in the Permian, and sort of productivity falling off a little bit. If the oil majors like Exxon and Chevron keep pumping a lot of money into it, does that prolong the asset life in a certain way?
It does. Yeah, the Permian is definitely getting more mature. Exxon and Chevron have such large positions within the basin that their assets are reasonably unaffected by that. Their acreage is big enough that they can maintain a very high production profile for many years to come. But it's certainly positive for the basin overall. The reason why they like it is because it's that very short cycle production, so they can invest today, they can get quick returns, and it's very low risk.
Something you also broke on this, Kevin, and kudos for you on that, is a huge pay rise that you get if you work at Exxon. We were talking in break, like what, oil companies are the place to be. Like you wouldn't have thought that a few years ago.
That's right. It's been all about tech and bankers, but this year it's oil companies where you want to be. Yeah, it's the highest salary increase program in 15 years. Average increase is about 9%, but top performers getting anywhere between 15% and 25% increases. So it's certainly good news after a very tough 2 to 3 years at Exxon's main campus up in northern Houston at the moment.
Kevin, do we take anything macro-wise from what we learned from Exxon as well as Chevron in terms of investing at the high end of the CapEx range, but still having the capital discipline, but also an enormous amount of buybacks? Is there a macro signal here?
I think so. Both companies are actually spending more money on shareholder returns this year than they are on capital spending, which is quite reversal for much of the past sort of 10 to 15 years or so. So these companies are really they're not chasing production anymore. They're not spending all they can on trying to get extra barrels. They're really rewarding shareholders quite significantly at the moment. So we shouldn't expect that the oil majors are going to increase production hugely over the next few years or so, and partly that's to do with climate change. There's a lot of risk over how the energy transition is going to look, but also as well it's paying back investors over what's been a fairly miserable decade for energy investors.